So good morning, everyone, and welcome to our next webinar where we're going to look at our retail trading report, but Sophie's also going to take us through some of the trends that we're seeing as we walk forward into 2023, as well as some of the highlights of the final trading quarter of 2022 and how that resulted for a number of you on the call this morning.
Last year, when I delivered our retail trading outlook, I was quite hopeful for the year ahead. Yes, we were in lockdown, but we were looking forward to no more restrictions and a return of some form of normality. We are here today with greater uncertainty facing businesses, and particularly those within the consumer market sector, largely due to the ongoing impact of high inflation, global economic unrest, and a cost of living crisis. There are mixed stories of these easing, but what we do know is that they have and are continuing to place strains on economies and severely denting consumer confidence. So the retail market in 2022 declined in real terms as consumers cut back on essential spending and because of the rising prices of food and fuel. And it led to a peak in inflation of 11.1% in October. We've seen that drop slightly in November and again in December, but it's still above 10%. So most categories of retail, consumer spending was pretty flat or negative, and where we've seen positive like-for-likes, that's as a result of high inflation. We know that consumer confidence drives consumer spending, and we have seen this at record lows since the records began. There's been a slight improvement over the past 2 months, but if we take out the second half, the previous lowest point was at 55.6%, which was due to the COVID pandemic. Concerningly for the UK sector, the rate of inflation has far outpaced the earnings growth in 22. This result will be far smaller disposable income for the consumer, which will lead to reduced spending on retail and particularly those non-essential items. The high street saw a year-on-year increase in January and February 22 compared to a relatively poor period the previous year when non-essential stores were forced to close. But what's interestingly is that the remainder of 22 lagged behind 21, and March to July benefited from being up against weak pandemic-driven comparatives. However, a restriction-free 22 has meant that we've had more of a consistent pattern across the year. But nonetheless, we've had the intensifying cost of living pressures, and the UK consumer demand has been particularly weak from July onwards. Volumes, therefore, were down even when we saw positive like-for-likes. And in most categories, they were down by more than 10%. Taking out 10% of volume is a significant amount of the discretionary spend categories. Spend through online channels fell back in 2022, following 2 years of significant growth due to people being at home. Despite this decline, penetration remains much higher than it did pre-COVID, and people have become more accustomed to shopping online, but at the same time, retailers have improved their websites and their fulfillment options. What we did see in 22 is we saw flat or at times negative like-for-likes for online in many months of 22. And given inflation rates, therefore volumes were even further down, which again serves to demonstrate that consumer spending overall was down. You can see from this also that fashion outperformed other categories, but again, fashion was against weaker comparatives in the prior year. Homeware was the hardest hit, and again, this is reflecting that consumers were not spending on those higher ticket items. When we look at this online growth by category, the overall retail market declined by 12.9% online, and electricals was the hardest hit. For many low-income households, discretionary income has fallen to zero, and therefore it takes a much higher level of consideration to make that purchase. Spending on non-food declined by 2.9% overall, and it's expected to drop by a further 3% in 23. Just as we saw back in 2008, value for money, and that's not just price, has become ever more important for the shopper. Before going on to Christmas trading, it's just worthwhile spending a minute on Black Friday, because total UK Black Friday and Cyber Monday sales continued to rise in 2022. Spend growing just shy of 1%, but on a very strong comparative to 2021. So the consumer did bring their Christmas shopping early in an attempt to spread out the cost and capitalise on deals and promotions in the weeks leading up to Christmas, but also not trusting that goods would be delivered in time given the postal strikes. Food and travel saw the largest growth, largely driven by inflation, but this also reflected consumers being able to freely enjoy hosting and or visiting friends and family after 2 COVID-impacted years. High street sales saw an increase in sales during December due to a UK-wide postal strike. The uncertainty over deliveries made customers decide to do a large amount of Christmas shopping in store instead of using online methods. Overall, consumers cut back on Christmas this year, and with record high inflation, that also means that volumes were down. So though relatively flat in absolute amounts, volumes were down in most categories by over 10%. Furthermore, what's interesting is that the UK had actually one of the weakest Christmas period growth rates compared to other major Western European countries. I would note, however, and this is where it becomes difficult to interpret, that we did have one of the strongest bounce backs in 2021 and therefore a strong comparative. But the weakening of the pound in the second half of last year meant that imports were more expensive, leading to that cutback on spend. Gifting in particular saw the weakest year-on-year growth, with volumes declining significantly. And yesterday there was a report out saying that toys were down by 6%, and that the greater proportion of those was at the gifting end of toys at less than £10, showing that people are not even spending on treats. The food and grocery sector experienced strong sales in the build-up to Christmas, although fiercely competing on price at time of high inflation and squeezed budgets. And the discounters, which we'll come on to, saw the largest growth. But people still spent on those high value items. And we've seen that through the good results of M&S. People either trading up for an extra treat or trading down to dine with M&S rather than eating out. Discounters, another strong winner. Soaring inflation in the UK meant that people were switching retailers. Aldi and Lidl have been the main beneficiaries here, and they saw a growth of 1 in 3 consumers switched to a cheaper retailer for the food and grocery shopping in December. High street retailers, postal strikes helped the high street, and in addition to this, the added FIFA World Cup meant that footfall was up. On the losing side, in contrast to that, we've seen the online, where like-for-likes did fall, but also picked up fast fashion, and people veering from fast fashion to prioritise purchasing better quality and longer lasting. But also, in addition to this, the ethical concerns around the production of cheaper fast fashion perhaps beginning to have an impact. Finally, retailer profitability, and I think it's going to be interesting to see when we've seen the like-for-likes, but actually see what the impact of the discounting and the inflationary pressures, not just on pricing and less volumes, but also on their own operating costs, have had on the bottom line. There's also another challenge is returns, and there's an increasing cost to absorbing the returns, and there's many reports out at the moment that those return levels are even higher. The supermarkets, Aldi achieved a remarkable 1.4 billion of sales in December 22. They were up 27% on last year. Earlier in 2022, they put themselves in 4th place, the 4th largest grocer, replacing Morrison's, but this only cemented their position. Cheese sales alone were up by 50%. They now have 990 stores, which would have also helped that figure. Lidl also experienced sales at 24% and increased their market share to 7.2% from 6.2% a year ago. And Asda reported stronger growth than their rivals Tesco and Sainsbury's, supported by its competitive pricing strategy. And Tesco's, again, an impressive set of results, still the largest supermarket in the UK, and like-for-like sales were up by 5.3%, which actually shows that perhaps the growth of the discounters was taken from the other supermarkets. M&S, also really pleasing to see such a strong British brand having a really good performance. Its market, and it's not only food, its market share of clothing and homeware rose to a 7-year high, and total like-for-likes increased by 7.2% in the 13 weeks to the end of December. In terms of the retail outlook, global data shows that overall consumers are preparing to reduce their spending over the next 6 months. Food and groceries is the only category where consumers expect to spend more, and 2 out of 3 people plan for this as they anticipate ongoing inflation will drive price further upwards and therefore demanding a greater share of the purse. Conversely, 44.5% of consumers plan to spend less on clothing and accessories, making it the worst category within retail, as shoppers seek out essential areas of their spending to cut back. This is why value and price for discretionary spend are going to be so significant, given the limited funds to spend on those areas by the consumer. Retailers will see a significant decline yet again in volume. In most non-food categories, price inflation will not be enough to offset reduced volumes as consumers become less able to spend on non-food essential items. The most significant of these on this slide is clothing and footwear, closely followed by homeware. Even food and grocery will see a decline, but yet will have one of the highest inflations, and therefore it will demand a greater share of the purse. It's also forecast that spending on online channels will return to growth as businesses also continue to improve their customer fulfillment. This will be against offline, that bricks and mortar growth being even flatter. This is, however, against stronger comparatives for 2022. We also return to getting some real benchmarking by channel without hopefully any disruption of further lockdowns. The current economic climate is challenging for all sectors, with all non-food categories set to decline in 2023. Electricals declined in 2022 against a strong comparative in the prior year, but this is where people are cutting back on those bigger ticket items. And it's difficult for these retailers to differentiate themselves apart from more competitive pricing. And homewares did fall for the same reasons as the DIY sector. Clothing and footwear, yes, a strong performance last year, but driven against weaker comparatives and largely by price increases. The second half was also impacted by people cutting back on spending, leaving spend for the overall year behind 7.4% behind pre-pandemic levels, and volume still down at 1%. So this year certainly started with even greater uncertainty and challenges than at the start of 22 when we were in lockdown. Unfortunately, it's expected that many of these challenges will persist. It's, however, the high levels of uncertainty which make it even more difficult for businesses to plan and navigate as this year unfolds. We've slightly changed the format this year, historically diving into the challenges and how retailers will respond. Because it's the consumer that is so impacted by the turmoil and economic pressures, we wanted to focus on how the consumer is reacting to these pressures, and therefore in turn what that means for retailers and how we anticipate them responding. Consumers are increasingly cutting back their spending on more discretionary products, such as clothing and footwear, DIY, gardening and furniture and floor coverings, with trading in these categories set to become even more difficult as retailers fight even harder for the share of the purse. Almost 2 out of 3 consumers stated that their shopping habits will change when purchasing non-essential and essential goods respectively. This has put price pressure on all retailers as the focus on lower prices and value for money is even more intense this year. And almost half of households strongly agree that they will have less disposable income. This is the highest proportion since the data began to be collected 6 years ago. So the cost-centric approach is particularly evident in the groceries retail space as Aldi and Lidl continue to take more share. Global Data's recent Future Sentiment Survey showed that 40% of households will be cutting back on retail spending a lot, with a further 35% cutting back a bit, and in particular a cautiousness around the big ticket items. As a result, planned investment into the home will in many cases be delayed or significantly reduced. And we've already seen this in 2022. I said that I would come back to the Gen Z, who they are becoming a far more established consumer base shaping the future of retail. I have one millennial son and two Gen Z sons, and I'm certainly seeing the difference in the way they shop. They utilise digital technology for everyday activities such as online shopping. Social media sites such as Instagram and TikTok are popular among Gen Z for purchasing products with ease and convenience. These platforms provide simple steps to purchase products, like links in their Instagram bio or swipe up links. Gen Z customers are very responsive to current trends, and retailers need to remain agile to adapt and recognise these changes in consumer demands. Subscription services vary from widely known entertainment companies, but also to food, clothing, and even gadget subscription services. However, 7 out of 10 households are now cutting back on leisure spending. And as we can see from this graph with the drop in spend, the future success of this model is in doubt as shoppers are being forced to prioritise essential spend over nice-to-haves. Convenience was a huge driver pre-COVID and probably the number one factor in making that decision to spend. This is taking less priority now and being replaced by value. As we leave the impact of store closures and lockdowns due to COVID-19, there's a new norm emerging in the sense of how consumers are shopping across different channels, but also their preference. Many are favouring a multi-channel approach, combining the convenience of choice of online with the value and experience of stores. Fast fashion is a sector that has been particularly felt the impact of this, and some retailers such as ASOS and Boohoo and even Zalando are having to revise growth forecasts. Moreover, a global data consumer survey conducted in March revealed that under 35s, who are a key demographic for online fast fashion players, are the most likely to change their clothing and footwear shopping habits due to the rising cost of living. This not only means they're buying less, but they're more likely to return items. And as I said earlier, returns is a key issue which is much more detrimental to the margins of pure plays, especially with rising costs of dealing with returns. Returns is becoming an increasing cost burden to the online channels, and retailers are having to focus hard on not only how they can manage these costs, but the cost of managing returns, but more importantly, how they can reduce the extent of returns. And data will play a key part in this. Perhaps it's why we saw M&S buy Thread to get that data on understanding their customer base. Even in a moment where factors such as rising inflation and the Russia-Ukraine war are weighing heavily on consumers and businesses, ESG concerns have endured and even assumed greater relevance. For example, price increases and budgetary concerns have pushed consumers to give greater consideration to shopping secondhand, whereas the situation in Ukraine has forced many businesses to reconsider their approach to operating in certain nations. The power of social media allows consumers to give immediate and direct feedback to businesses they feel do not align with their values. 2/3 of UK shoppers believe that ethical features are essential or nice to have when making a purchase. You can see the significance of these ethical matters in that whole shopping decision. We've noted in prior years the expected big increase in the second-hand market, and this only continues to be a big growth area for, in particular, fashion, and has been accelerated by the cost of living crisis. According to global data, the second-hand apparel market in the UK is set to grow by over 85% between 2022 and 2026. As consumers not only look to save money, but also improve their environmental footprint. Indeed, 58% of consumers who bought second-hand apparel in the past 12 months did so to get items at a lower price, and over 1 in 4 did so for environmental reasons. So now that we've looked at the consumer, we're going to explore how retailers are responding to these changes. Next slide. And on here, we've listed some of the areas that I just want to focus on for the next 10 minutes. Retailers are increasingly turning to loyalty schemes to protect against trading down, but also to build up their knowledge of their customer base and leverage from this data going forward. In grocery, with mainstream supermarkets often unable to compete with the discounters on value credentials, they have instead adopted creative models of building brand loyalty in an effort to prevent switching. But as well as this, even discounters have started to embrace loyalty schemes. And we've seen this with the Lidl Plus loyalty card. And now Aldi is now the only major grocery retailer that has not got a membership scheme. Asda also launched its Just Essentials value range, which proved so positive and popular that the supermarket had to limit the number of purchases that a shopper could make. Social responsibility is a hot topic amid the cost of living crisis, and ensuring that families are able to feed their children is at the centre of some of the retailers' promotions. Food banks, donation schemes, partnerships with charities and community grants are among the ways retailers are trying to serve their wider communities. As in food, to meet the demands of cost-conscious consumers, home and apparel retailers are starting to also offer cheaper alternatives. And John Lewis, for example, launched its affordable anyday homeware range, but also its promise not to increase the items such as school uniforms, where 95% of its products remain at previous prices or lower. As Gen Z are starting to become independent consumers, retailers are having to implement strategies and products based on what appeals to this new generation, resulting in growth in personalisation, online and sustainability initiatives. Retailers are able to impact their purchasing decisions using product placement and influencer advertisements. Gen Z are particularly pertinent for this shopping habit, and it's supported by the stat that over 2/3 of Instagram's 1 billion users are under the age of 34. The other factor to know is that the oldest part of the Gen Z is at the age of 26. So they may well still be living at home and not feeling the full extent of rising living costs and household bills. But they are feeling some pinch, and their average shopping basket is shrinking. And they're also dismissing perhaps some of the luxury brands and taking cheaper options. The pandemic-driven online surge has started to wane, and emerging now is this new hybrid model of in-store and online offers. The challenge presented to businesses is trying to seamlessly integrate in-store and online in a profitable way. Meanwhile, as customers more than ever are now willing and able to browse products online, high street stores need to offer something different. And there's a growing trend to create and bring in store this intrigue for customers to bring them in store. Offering an enhanced store experience can help retailers to differentiate themselves also when they're trying to justify high prices. We're seeing Gymshark open its first physical store on Regent Street with this engaging in-store experience, as well as hosting special events and hangouts and workouts. So a real variety in terms of going far beyond to just being purely a transaction store. We are also seeing more traditional retailers announce further store expansions. M&S has just revealed that it's going to launch a further 20 bigger and better new shops, and it's described them as great stores by their management, delivering a better experience, and its belief that stores are a core part of its M&S omnichannel future and giving it that competitive advantage. Many areas of retail operations drive ESG considerations. However, two of the major offenders are vehicle usage and apparel materials. Vehicles are responsible for the most emissions in processing online orders. And for Ocado, they produce 70% of the company's total emissions. As a result, retailers and logistic companies are moving towards electric vehicles and natural gas-powered vehicles to reduce emissions. Retailers are also improving sustainability of their materials, and we saw this with the likes of Boohoo opened Boohoo Lab to test the performance and durability of its garments. So to end, in order to navigate the challenging times again, it's going to be key for retailers to remain focused on the priorities, and this has never been more important. So what are the key takeaways? The first, strengthen loyalty schemes and own brand entry-level value options to allow shoppers to trade down and discourage switching. Understanding and tracking fast-evolving consumer demand at both the macro and micro level. For example, in the home category, promoting small items that are relatively affordable and appeal amid rising energy costs. Using social media to promote new products, keep up to date with popular trends and promote sustainability efforts. Seeking consistent innovation across subscription services and drive innovation both online and in physical stores to enhance value, convenience and customer service during the shopping journey. Innovate those modern store concepts to build brand awareness and differentiate from competitors, and add to the multi-channel offering to entice shoppers. And retailers are having to incorporate ESG into everyday operations, from how they run their business to how products and materials are sourced. This focus will only increase as Gen Z continue to account for more of the UK's consumer shopping spend. And local solutions to mitigate global issues. Retailers should aim to localise their supply chains as much as possible to avoid global supply challenges and improve the sustainability of production and distribution. So where I started, there is lots of uncertainty and challenges do persist. However, whilst it's difficult to invest when working capital is so fundamental, businesses cannot stand still. And what we tend to see in markets like this is that the strong players do get stronger and the weaker ones do indeed get weaker. We also see, on a positive note, that those stronger players are far more enduring, and they are the businesses that outperform the rest for the next decade. So managing cash and working capital, continuing to invest in the right areas and truly understanding the customer and the challenges of your target customer has never been more important. Ultimately, it's about prioritising where to put the effort and where to put the limited resources.
And so just before we take a look ahead, on the next slide, we can just remind ourselves of the context that we're in and why we're in such a challenging situation from both an economic perspective, but also a financial market perspective. And Sophie, you mentioned that inflation has been a really important driver for the current economic backdrop. And in 2022, it stayed much higher than most of us were expecting as we entered 2022. We did, of course, have that existing inflationary shock stemming from COVID-19 and some of the supply chain issues, but that was extended this year by Russia's invasion of Ukraine and the impact that that had on commodity prices. And what that meant is that what was a transitory episode related largely to goods and then related largely to commodities started to become a lot more systemic, and then price increases started to bleed through also into services and into wages. And of course, because of that, adding to the squeeze, we've had that complete change in stance from central banks. Again, heading into last year, many forecasts were assuming just 1 or 2 interest rate increases from the likes of the US Fed or the Bank of England. Of course, in reality, we've had many more than that. UK rates today at 3.5%, and in the US, close to 4.5%. For financial markets, that combination of high inflation and rising interest rates has been very negative for equities and for bond prices, and we've seen that significant increase in bond yields. Now, looking to the future into 2023, the good news is that we think that inflation has now likely peaked. And the chart you see here shows for the US, but the picture is pretty much the same around the world, including in the UK. And we're projecting that UK inflation, which had ended 2022 at just over 10%, will be ending 2023 at around 3.5%. So still above the 2% target, but far lower than we are today. Now, one factor behind that is commodity prices, and we've been pleased to see the decline both in oil prices and in gas prices, which have declined very substantially over the course of the past few months due to good efforts to reduce demand in Europe and also to build up storage. But the second factor in this is that lower demand is also affecting the pricing mechanism. Sophie, you talked a lot about how discounters are starting to perform and how consumers are starting to adjust their purchasing habits. And that's good news in the longer term, because if lower demand is leading to lower prices, that in effect means lower inflation. Compared to the 1970s, what's been promising about this, at least in the longer term, is that because wages have been rising more slowly than inflation, that's placing that natural constraint on demand, and we don't have that spiraling effect that we had in the 1970s, which meant that inflation lasted for much longer. So overall, we're looking for inflation to be falling from today's levels, and so ending the year at around 3.5% in the UK. Now, what does that mean for interest rates? Well, we can see that on the next slide. And again, we're expecting to see a peak in interest rates coming relatively soon. Interest rates are likely to keep going up in the near term because inflation is just so far above central banks' targets. They wouldn't have the credibility to stop hiking interest rates at this point. But we think that by the end of the first quarter, we are likely to see central banks starting to pause and understand the effect that the rate hikes so far have had on the economy before they make their next move. So in the UK, we're looking for 2 more interest rate hikes, which would take the base rate to 4.25%. In the US, we're looking for a pause at around 5%. And then later in the year, we think that central banks will start to consider cutting interest rates, because by then inflation should be low enough, even if it's not quite at the target yet, low enough to allow them to refocus their attention towards economic growth and consider cutting interest rates. So we're looking for potential interest rate cuts from both the Bank of England and the Fed towards the end of 2023. Now, what does that mean for economic growth? Well, we can see that on the next slide. And broadly, we're looking for a picture of the global economy starting to bottom out at some point in the middle of the year. And the important trend in that you can see in the next slide, and I know, Sophie, you mentioned this as well, is that trend of wages starting to come above inflation once again. Now, of course, when wages have been below inflation, it's meant that consumers have had to either draw down savings or limit their consumption in order to make the books balance. Whereas by the middle to the end of this year, we think that wage growth should once again return to be above the rate of inflation, and that should allow consumers either to build back their savings or to consume more. And clearly that's a good thing, for the economy. Now, of course, in addition, China's recent reopening and the end of zero COVID policies there should also be quite supportive for global demand. And just while I'm on this global outlook, it's worth noting we will have regional divergences, which will be important for globally focused businesses as well. Generally, we're expecting to see the bottom for Europe, the UK, and China come sooner, because the economic pain has been more front-loaded as a result of some of those energy cost pressures. Whereas in the US, we're looking for the trough to come later in the year because the performance so far has been relatively robust. But of course, those savings that consumers have won't last forever, and we will likely need to see a cutback in spending in the US later in the year. So overall, it's a year where the first half looks relatively challenging, with high inflation, rising interest rates, and slowing growth. But the second half of the year starts to look more promising, with lower inflation, falling interest rates, and accelerating growth. But of course, in the absolute sense, it remains a relatively challenging economic environment. On the next slide, we can get into a little bit of what it means for financial markets. And of course, when we're talking to our clients at UBS, that's often of the highest level of interest is, okay, well, that's what's happening with the economy. What does it mean also for what's going to happen with financial markets? And of course, that also has an important bearing for businesses and their financing conditions, whether it's as a matter of interest rates or business confidence or equity market financing. Now, a big question that we're getting at the moment is when markets will return to having a sort of sustainable rally after the big sell-off we've seen over the past year and this period of volatility we've had in the past few months. Typically, when we look historically, we see that there's two things that are happening when markets bottom. First is that investors and markets are starting to anticipate interest rate cuts. And the second, we can see on the next slide, is that markets are starting to anticipate a potential turning point for an economy. And they typically will start to bottom between 3 and 9 months before the bottom for the economy, because they're anticipating future earnings. Now, we project that onto our forecasts. We, of course, are looking for interest rate cuts towards the end of this year. We're looking for that trough for the economy to come around the middle of the year. So that means that for us, we think that a sustainable rally for equities should start to take hold around the middle of the year, around the second quarter. And we're talking a lot with our clients about phasing strategies, how they can gradually enter into markets during this period of uncertainty and volatility in order to take advantage of that more promising outlook in the second half. Now, the next slide shows some of the longer term projections. And the good news about some of the difficulties we've had both on the economy and for financial markets in the last year is that actually the longer term outlook for investors has improved. And we can see from this slide that the valuations of equity markets, which had hit multi-decade highs towards the beginning of last year, have now come down closer to their longer term averages. And that typically is more consistent with stronger longer term returns for equity markets. And on the next slide, we can see the returns you're able to get on bonds and the yields you get on bonds much, much higher than we've had at any point really since the global financial crisis. And of course, for investors in bonds today, that means a more promising longer-term outlook for fixed income investors. So what we've been doing with our overall projections, you can see on the next slide, is generally increasing the expected return that we've got for a whole range of different diversified portfolios for a given level of risk. So just to take an example, for a balanced portfolio today, we're looking for returns of just over 6% on an annualized basis over the longer term. At this point last year, we were looking for a return of only around 5% on an annualized basis. So it has been a difficult year and markets have clearly fallen, but we do think that the longer term outlook from here is more promising as a result of this increase we've had in interest rates and the drop we've had in equity market valuations. So a tough start to the year, more promising second half, both for businesses and for financial markets. And we think that the longer term outlook is looking more encouraging from here. So we're discussing these phasing strategies with our clients. And the next slide gets into some of the more thematic topics that we're looking at and with some of our clients and how they can make allocations in the current environment. Now, the first is that within equities and within the stock market, we're looking at making allocations a little bit more defensive in the near term just to navigate some of these economic uncertainties that we're facing, focusing on sectors like healthcare, consumer staples and energy, all of which we think should be relatively resilient in the current economic environment. We're also looking for strategies that can help generate income because we think that that's valuable to be able to earn that extra income as an investor during uncertain times and when the macroeconomic backdrop is so uncertain. Also good news is that income opportunities have become more available recently because of that increase we've had both in interest rates and in credit spreads. And then for longer term investors, we continue to talk about the value of alternative assets, whether that's hedge funds or private equity in the context of a globally well-diversified portfolio, because we think that this can help mitigate the risk that when equities and bonds fall together, the portfolio is too badly affected. We continue to emphasize the importance of investing sustainably and in a diversified way. A number of sustainability-linked themes did have relatively weak market performance in the last year because they tend not to be as exposed to energy prices, and energy was one of the key trends over the course of the past year. But we think that going forward, having a well-diversified, sustainable portfolio remains one of our preferred strategies for globally diversified investors. And then finally, just to mention this theme of an era of security, and we think that this is going to have important implications both for investors and for businesses. We can clearly see that as a result of the tensions between the US and China and Russia's invasion of Ukraine, there is an increased emphasis on security, whether we think about energy security, food security, or cyber security. And that's having big implications across a whole range of industries and investments, and businesses are having to rethink their supply chains as they increase the emphasis on security, perhaps even if it comes at the cost of efficiency and price. So with that, I will stop there. I hope that's been informative on our economic and investment outlook, and I'll hand back to the host.
Really interesting in that when we sat here in the latter part of 2022, we were perhaps extremely nervous about how the world of 2023 was going to look, yet it feels as if we may have a tale of two halves. But these first 6 months are going to be difficult. That was something that clearly came out of the session we've just had. Supply chain continues to be something that we see as being top of the agenda for clients and businesses that we're talking to. Fraser, any thoughts from you on what people can do with that supply chain, how they can manage it perhaps a little bit better, particularly around that piece from Sophie, that profitability is perhaps going to be a little bit tighter in 2023?
I think, look, the last 3-4 years, supply chain teams have been under the cosh. The people have fought hard to secure supply, to build resilience, and that's what we're finding from our client base is resilience and visibility is taking priority over efficiency. There is a lot of stock out there in the UK that retailers need to burn through, and we've got to become conscious that they'll be making decisions on the buy for next Christmas. And I know that seems a long way away when we're in January, but that's the cycle of the retail stock. So it's how those teams in supply chain, procurement, finance, merchandising and commercial all work together. And again, the feedback from the events over the last 3-4 years is how it has brought those teams closer together, and even remote working has made them work together to manage their stock budgets, and that's going to be crucial. And building that resilience, the focus has been on one supply and sole supply, but what we're finding now is that they're going for dual supply, dual sea freight, dual warehousing in the UK. And again, with all the issues we've got in the courier market, make sure you've got a backup plan. So yeah, it's really focusing on the next 6 months on building that resilience on the supplier base, and then how you can onshore, which is probably a 3 to 5 year project rather than a 6-month project. So you've got your short-term quick wins and then your long-term strategic initiatives.
And that point to onshoring is something that we've seen gain more and more traction for a number of reasons. One being around that social accountability, Tim, that can fall into the very wide bucket of ESG. Thoughts on how some of the audience today, where perhaps ESG needs to take a step back for the short term as we battle the headwinds, but certainly should be on the agenda as we come out into the latter stages of this year, where it continues to be right up as a priority item. Do you think onshoring can help with some of that?
I think it can. I mean, to your first point about, where does the sustainability and ESG agenda sit in the context of the turbulence we have at the moment? I mean, one of the first questions that are likely to be asked of a business going forward is, how are you managing the leadership and governance aspects of sustainability? So my first point would be to, even though we're having to weather significant turbulence at the moment, do set aside some headspace to think about some of the issues that are coming down the track. I mean, the sustainability agenda at the moment is really all about what's going on in the supply chain and understanding where there are risks and opportunities. And as we heard throughout the presentation, where consumers are looking for value, sustainability is part of the value proposition. But it's important to understand within the sort of the subsectors of retail and consumer goods and services, which bits are relevant. Onshoring may enable enhanced resilience, but again, it's about finding the right balance. Onshore too much, and then you could burden yourself with additional friction and cost associating with generating new requirements. Equally, offshore too much, and there are external vulnerabilities there.
The fight for the purse, Sophie, that we've talked about is still very much up there on the agenda. We know that was a factor to our Q4 trading. What's your view around the market that we're facing over the next 12 months, and perhaps that tale of two halves, on how people can protect the brand and still manage the markets and continue to keep those volumes to effectively get back to liquidity and manage that working capital as you highlighted?
Great question. We have got a smaller amount of the purse which is now available for discretionary spend, and it really does go back to people are making more considered purchases, and therefore it's essential that you've got a relevant product and it's the right value. I mean, when it comes to the extent of discounting that we'll see and against brand erosion, that's a real balancing act, isn't it? Because in reality, that comes back to how high up stacked is your storeroom and how much stock do you need to shift? What's the shelf life of that stock? Because a particular trend item might not be in fashion in 12 months' time if you continue to hold on to it. How much do you need to drive your working capital better against? To what extent do you actually discount that stock? And what impact does that have on your brand? Which is, we've seen over and over again, when you dilute your brand as a result of discounts, it takes time to rebuild it. So it's a real balancing act, and in a sense, going back to ESG and all the ethical matters, if businesses can afford it and they do have that spare stock, they might also consider what they do with that stock to support the wider community. So I think it's going to be a really competitive landscape for the next 6 to 12 months in the non-discretionary spend side, and in the essential spend as well. On the discretionary and non-discretionary, it's going to be really competitive. Price and value is going to be key, because the consumer continues to have a tight purse, and trying to differentiate is going to be paramount for those in the middle.
And Neil, we know that margins are going to be lower for this year, and retailers taking strategic decisions that allow them to perhaps work to get cash back onto the balance sheet, settle into a more stable market in the latter parts of 2023. Other things to think about where, you from a tax perspective, that will allow people to just manage those cash flows in the most efficient way they can, or perhaps manage those profits on the other side of the equation?
Yeah, thanks, Laura. Well, I think it's fair to say there's always something tax related to think about, as Nadine Zahari has found over the past week. I think on the picking up the theme Sophie mentioned, I think over certainly the next 12 months, it's going to be a combination of battling the headwinds and investing strategically to give you a better outcome for the medium term. And I think on the tax side, the points to watch, I think they probably fall into 3 areas. It's a combination of good housekeeping, forward planning to support those strategic investments, and keeping a very close eye on cash taxes. So I think on the good housekeeping side, it's good old compliance, making sure you get things on time, right first time, thinking about your payments on account, whether that's VAT or corporation tax, making sure they're appropriate. If you've identified any errors, whether it's on the employment tax side, VAT side, get a handle on those and be upfront in your negotiations with the tax authorities, so that you're in control of the process. I think on the forward planning, looking at your investment strategy, if you're doing something innovative, are you making sure that you're claiming the benefits under the R&D scheme? Have you got anything that will fall into pattern block? Sophie mentioned store rollout for a number of the big stores. Again, thinking about capital allowances, tax relief. If you're doing something energy efficient, can you make sure that you fall into the criteria to get enhanced allowances? And then I think we all know that the labour force is having its own challenges. So, cash tax plays into that as well. Can you restructure pay and incentives? Can you take flexible labour options? That's got a whole raft of stuff around it. IR35, and then the big thing, as Fraser's outlined, looking at your supply chain. I think in my experience, talking with clients, the last 18 months, 2 years, has all been about sort of sticking plasters to keep goods moving, certainly on the international front. And a lot of retailers are now looking at that, taking a step back and saying, can I do something in a more efficient way, so that it is very smooth but also cost effective. But I think anytime you're looking to adapt your supply chain, there's a whole raft of issues that you need to think about, from VAT, duty, corporate tax, transfer pricing. So, go back to where I started, there's plenty to think about.
And you picked up an interesting point there that is one that is becoming more prevalent in the discussions we're having about labour. There has been a shortage of labour in the sector, which has given more challenges to opening. And Sophie, you picked up on perhaps how important that store experience is going to be in the value proposition. Thoughts around, how can people look after their workforce? You talk about that Gen Z demographic, Sophie, which, using your JD example, the majority of the people who are going to be serving those customers are going to be into that Gen Z bucket. How are people going to make sure that that store experience is not lost when they're walking into the store and they meet perhaps someone who's working on the shop floor who isn't bedded into that brand? Any thoughts, Sophie, from you?
I'd say training. I think there's been such a big turnover of people within these sectors, and there is a shortage, but it's about training and getting some consistency in terms of that service delivery and knowledge within their people of the product and the customer that they're serving, and taking into that training customer feedback, listening to their customer. It's also having people who are developing this training at the same age group as your customer base, because that's at times we're looking at boards which are quite different to actually your target customers. So it's really understanding your customer demands and taking feedback, having the right people feed into that process, and developing. And this is where businesses cannot stand still. They do need to spend on certain areas in order to create a sustainable model. And one of them is their people, because that's such a key touch point with their customer. And the other is data and technology. So they're going to have to continue to invest to make their models more efficient and more customer and cost centric.
It also plays back in, Fraser, to that supply chain piece, in that customer experience is so important. And one of the things, I was talking to one of our colleagues in the US, and they equally are releasing their annual report, and the big theme that correlated across the two was the importance of data and how prevalent data analytics has become twofold. One, in terms of the customer journey, but two, in terms of being able to really manage your supply chain with robust data. Any thoughts on that, Fraser, of how important this era of real, true analytics to manage your supply chain is in how people can get back on top of that part of their business?
I mean, it's 100% crucial. Knowing what your customer wants, knowing their ordering patterns, knowing what channel they're ordering through, and then feeding that back up through the supply chain. So you've got resilience in there, but you've got that speed and efficiency as well to be able to react. Gymshark are a great example of that, how they've got a young board, they listen to their customer and they react to the trends that are going on. So yeah, it's absolutely crucial. And then looking at their shopping habits and how you can trade them through both channels, because bricks and mortar has made a comeback this year. Through lots of different issues within the supply chain, mainly through the couriers. But then if people are trading in store, how you can really optimise that click and collect proposition and how you can get people through the tills, because I still think there's a whole piece of innovation and data of how you can get people through tills quickly. The supermarkets and grocers have been fantastic at it and market leading, but your traditional ones, you still get queues out the door at Christmas. So again, your click and collect is normally tucked away in a corner, it's out the way, and the theory is you walk through the store and you make an impulse purchase. But again, it may be a bit short-sighted and get people in quick and get people out, because it just detracts from that shopping experience. And customers are getting experienced and savvy, so That data all the way through the supply chain. And retailers, I've been in the industry 30 years, are guilty of moving stock around, and often that causes excess costs. Isn't very ESG friendly. So again, it's about having the right stock in the right place for the right customer.
And just picking up that point to ESG, Tim, thoughts on that click and collect piece, people perhaps not having so many deliveries to their doorstep with the challenges of climate change. Any thoughts as to how that will resonate with consumers as we go forward?
Yeah, I think it introduces one of the fundamental conundrums, I think, in the context of this discussion, which is have we reached peak convenience? And I think there's a spotlight on the topic of overconsumption at the moment, which introduces an immediate tension between what is sustainable, so growth in the retail sector versus what is sustainable, and what's an appropriate balance. So I think that's going to be a theme going forward, and I think again we saw some of the data around people focusing on things that they really need as opposed to that which is just a discretionary spend. So I think that the click and collect and the whole convenience aspect of the economy is going to come under significant pressure as we have to bear down on transport and any other forms of greenhouse gas and carbon emissions. I think will introduce additional levels of friction into what people have been used to certainly over the last 10 years or so.
Picking up that theme from Kiran, James, we've been talking about this first 6 months of 2023 still being quite challenging, particularly for retailers that have a hangover of stock. Now, unfortunately for some, that will mean that they are facing having to restructure a business. For others in the audience, where that could be an opportunity to invest, acquire, diversify, picking up some of the themes from Sophie this morning. What are your thoughts just around that piece where actually if we look at a 12-month landscape, positive signs in the latter parts, but perhaps some more challenging times in the next couple of quarters, what can people think about?
And certainly, Laura, I think there's definitely going to be, as I touched on in my webinar pre-Christmas, there's definitely going to be opportunities arising that there'll be sadly some people that will not make it through and will have to avail themselves of a restructuring process. From an acquisition point of view, then I think the key advice that I would be given is to be fleet of foot. We've seen a number of examples pre-Christmas where Next in particular were very quick off the mark in securing acquisitions. House of Fraser as well are very good at moving forward on that basis. So I think the key advice I would be saying to people is, be very clear on what you would want to look at. Make sure you're funded, and then move very quickly. You have to be in the game to get those opportunities. And if you are acquiring through a distressed process, then you have to really understand the risks that you'll be taking on. You're not going to get a long, elongated diligence process to uncover every possible issue that there might be there. It's going to move very quickly. So another key piece of advice I'd be, if you've got any uncertainties, then surround yourself with advisors that understand the process.
I know you and I have talked about some of the themes of where consumers will continue to spend in those positive outlooks, particularly perhaps as there's some easing in the latter part of the year, sort of hotspots of where you've been seeing consumer confidence as we go into 2023?
I think we're seeing some resilience in travel and leisure. Certainly, travel industry seems to have quite a few reports out of confident bookings going into this year. And again, we've had, from a retail perspective, difficult comparability with the last 2 years, and everyone seems to reflect on where we are versus 19.
Will consumers be able to accept higher prices is one of the big questions that we're being asked. Or will we be facing further promotional discounts to allow the price of product to be accessible to the consumer? Tom, any thoughts around that point on, do we think that 2023 is going to have to see an element of discounting? How do brands protect their brand value? What are some of the strategies we see as working in the market at the moment?
I think it would be really interesting to see the value engineering that goes on in both FMCG and broader retail. We had the phenomenon probably in the global financial crisis of the pound stores, and that price point being a relevant metric in the market, and that's less and less nowadays with all pound stores being multi-price, and therefore the consumer not being able to determine as much value from products as they would normally. That's now being translated into very heavily invested marketing campaigns by some of the big grocers to defend prices against lower alternatives like an Aldi or a Lidl. So I do think there is room and scope for retailers in some categories to do more value engineering to hit price points that would please customers and see value come through. But equally, I think we always talk about an informed consumer, and I think that different ways that they will get value is through bulk buys, loyalty programs, and the price differential on Tesco club card prices to normal is pretty significant. And if you can play the game and it might lead to less loyalty between brands within stores, because you will trade and you might take and switch out products to get the offers. So there will be mechanisms that the consumer will be able to utilize to be savvy. But I equally see that there will be, more that's done by the kind of major brands to compel what value means in their products with either promotions, offers, and or pack size changes.
Sophie, it's one that we've debated significantly around this year's outlook of volume versus revenue. Any further thoughts from the conversations that you've been having with retailers, what people really see is going to be the key player for this year?
I mean, value is certainly, and I would echo everything that Tom has just said, particularly in connection with the grocers. I think in reality, the discounting for non-essential spend is going to be largely driven by how high the stock room's filled up. If you're sitting there with a full stock room and you need to shift that stock, you're going to apply more discounting. But I think it's going to, retailers are going to have to manage this really, really carefully, because the one thing that they don't want to do is erode their brand, because then it's really difficult to build that back up. And like I say, we haven't seen the actual bottom line performance of retailers, but I am sure that they've been hit, even those with the positive like-for-likes, that they have been hit by the level of returns, the discounting they've had to apply, and their own cost base, which has been increasing. So I think this dilemma between discounting and not discounting is going to be driven by your stock levels having the relevant product and the working capital situation of the company.
Conscious of our time, and we're coming to the end of our session, some really interesting themes that we've picked up that hopefully our audience can take away, give some thought to. Contact details for everybody are on the screen as we finish today. Equally, for those who haven't had our retail forecast report, it is available to download, and please contact us if you would like access to that. And we also, of course, have our quarterly webinar series. So with that, I'm going to ask each of my panelists to just give one final thought to the audience around, as Sophie said, we would love to sit here with a more positive outlook, but actually I think it feels like a tale of two halves for 2023. I look forward to seeing what the market is and does over the next year. We thought it was going to be a lot worse sat here in Q1. I think it's better than we thought, so we're very hopeful that we see some real positive shoots as we go through this year after a number of difficult trading years. But Fraser, a couple of few words as thoughts to leave our audience with this morning.
Oh, no pressure, Laura. Yeah, just obviously retailers, invest in your people, invest in your technology. As Sophie says, data's key. Getting people through those tills as quickly as possible. I still think there's a real lack of innovation in that point of sale area for existing retailers. How many of your customers walked out empty-handed over the peak period when they could have had bags full of shopping? So really look at getting those customers through your stores and use that innovation that a lot of the grocers use now to improve the checkout experience.
James?
Pretty similar to Fraser. I mean, the customer experience for me, you're moving into the next 6 months, maybe longer, where probably the key driver of your business doing well is going to be what the consumer can spend. So you hear all those horror stories of people going into shops that are ignored, or you see a big long queue that you think, well, I can't be bothered waiting in that, or as Fraser picked up on earlier, making sure that your outlets of your online delivery mechanism, then make sure that that's spot on. I think absolutely the customer experience who's going to have limited funds to spend, and absolutely critical for me.
Sophie?
Prioritise. You know, there are limited resources and there's limited time, and it's determining where you put your pound and stop, and determining what you stop doing as well. But ultimately prioritise to actually develop a sustainable model, because those businesses that come out the other side of this are going to outperform for the next decade. So you can't stand still. You do need to continue to invest.
Like Fraser and James says, customer experience is going to be really important. I would equally challenge a lot of retailers to get their employee experience right. The difference a motivated and well-skilled labour team can have on increasing in-store conversion is massive. And I think there's going to be an element of trading required in the next 6 months, and your in-store staff are a huge weapon that you can have to win share over other competitors.
And Tim?
What's your supply chain? One of the effects of climate change is mass migration is increasing around the world. More people are finding their way into the supply chain as modern slaves. As you look to bear down on costs in your value chain, your supply chain, if it looks really good in terms of price, then make sure you're very diligent around how those prices are being driven down, and don't get caught out if there are modern slaves that have crept into your supply chain. Be vigilant.
So with that, I thank the audience, I thank my panelists, and we look forward to seeing you all again on our next webinar. Thanks all.